Good morning everyone and welcome to Morning Markets from True Potential. Before looking at how asset markets performed yesterday, I just wanted to remind everyone that we have our Do More With Your Money show later today, so please do subscribe on the YouTube channel and you'll be notified when that comes live. So looking at asset markets yesterday, Kevin mentioned that we had the US markets closed for the Thanksgiving holiday, a more subdued day in markets as a result, but we did see continued positive performance from European and Asian equity markets over the course of Thursday. A couple of things that have really played into that continued slightly more positive backdrop really was one, I think the minutes from the Federal Reserve that really did suggest that their policy action and that aggressive interest rate policy action that we've discussed has started to impact. And I think one sentence that struck me in the minutes was that financial conditions have tightened significantly in response to the committee's policy actions, and their effects were clearly evident in the most interest rate sensitive sectors of the economy. So that gives you a sense of really how the lagged effect of monetary policy working its way through. I think the other thing yesterday worth touching on is in Germany with the IFO, which looks at business confidence, and that showed an improved reading relative to expectations. And that maybe just helps that narrative that we've discussed over recent weeks, that maybe there is some nascent signs that the decline in activity might not be as sharp as some people have been expecting. I think just in context then, how have global equities performed over the month to date? We're up about 6% in local currency terms. If you look at some of those more economically sensitive areas, thinking about Germany, the German equity market is up around 9% in that same period. I think yesterday as well we heard from the European Central Bank, again the minutes from their last decision, and that brought I think two things for me to really consider and discuss. One, the fact that they are still continuing to suggest that interest rates need to move aggressively. They are concerned about the inflation trajectory in Europe, and really two reasons for that. One, governments have been very clear in the fiscal response to help households and industry across large parts of Europe. They're just concerned that that might impact further inflation as we look forward. And secondly, concern around the second order impacts, that higher levels of inflation start to become embedded in some of the unionised wage settlements that we'll see over the coming months across parts of Europe. So two things there really to monitor. Similar vein, we heard from the Deputy Governor of the Bank of England yesterday expressing his concern as well on the inflationary trajectory, which I think is a little bit at odds with some of the minutes that we saw in the discussion in the monetary policy report just a number of weeks ago. But clearly, I think one of the things that this does highlight is the challenge that asset markets and central banks face at this point in time. Kevin mentioned yesterday some of those deflation trends that we're seeing, particularly as it relates to US consumer goods. So again, some areas of the economy showing a degree of deflation, others inflation, which complicates that picture. And again, speaks to why at a portfolio level, diversification is really crucial as we navigate our way through these changing economic backdrops. I think the other thing just to touch on as we come to a close is China. We've discussed over the recent number of months the concern that there has been in the Chinese property sector and the level of debt there, and really the lack of government support that has been coming through. What we've seen over the last 2 days is some clear signs that the government are maybe going to provide some support to the developers, in that we've got a 16-point plan for the property sector, but we also have heard a number of the large state banks in China providing additional credit to those developers. So I think that's an important development to monitor. However, I think as we are all very much aware, the key determinant of activity in China is going to be a change to the zero COVID policy. And as we can see at the moment, COVID cases continue to increase, and we have further restrictions in movements in China. So that policy isn't changing and will continue to impact economic activity. I'll leave it there for today, but please do join us again next week. Many thanks. If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.